What's going on, everybody? Jeff here. Welcome back to the channel. Jerome Powell saving the market again. Now, is this going to last, or is the normal cycle going to repeat ahead of the advanced second quarter GDP estimates? I'll cover everything in this video. Let's get right into it. So first off, today, the SPY gapping up a little bit overnight, had a steady incline in the morning, some consolidation, waiting for that Fed fund rate number to come out. Obviously at 2 o'clock, we get that whiplash as expected. 2:30, Jerome Powell comes on. 2:35, we get that solid, strong green candle to the upside. Over 397, off to the races, all the way to almost 403. Now, SPY did close the gap to the upside all the way back from June 9th, which was the day before CPI. Now, it doesn't mean we have to get that pullback now that it officially closed the gap, but it is something worth noting. Now, I will talk a little bit about this chart and a little medium-term outlook, but the Federal Reserve raised interest rates 75 basis points. There were two numbers on the table, okay, that investors were currently pricing in, 75 or 100. Now, if you take a look at the target rate probabilities, which indicates how much the market is currently pricing in a rate hike, this table, which is cmegroup.com, changes intraday, all right? And the 225 to 250, which is the 75 basis point, all right, was only priced in about 73%, and actually 27% of the market was already priced in for a 100 basis point hike, which would bring the total to 250 to 275. Now, this said two things to me. Okay, and I remember this for the meeting in September. It said two things to me. One, if we got that 75, investors would feel calm and we had plenty of room to move to the upside. However, if we got that 100, the market was not expecting that. Not enough of the market was priced in for a 100 basis point hike, meaning if we did get that 100, there was plenty of room to move to the downside. Now, the pattern played out perfectly. This is a chart of the three previous meetings. It shows SPY gapping up and just consolidating intraday throughout the day. You can see it timestamped down here at the bottom. We get a little bit of algo move. We get that number released, a little bit of a whiplash. Today, we didn't really see much of selling pressure come into it. Then Jerome Powell comes up, answers questions with very little specifics, gives very brief detail, just really tends to repeat himself and try to instill in investors that they're, trying as hard as they can to prevent a recession and get their overall job done and get inflation down to where it needs to be. Investors buy it up, and this is what we call the Powell pump. Now, good portion of the time, I think it's about 80% of the time, 80 to 85% of the time, after the Powell pump, the following day we get the sell-off. Now, this could vary because we do have GDP tomorrow, but it's definitely something worth noting. Now, this article states IMF slashes global GDP forecast as economic outlook grows gloomy and more uncertain. One thing I want to point out about this article is, even just by reading the title, this title is forward thinking. And while you have Jerome Powell sitting there saying that we don't believe we're going to slip into a recession, economy's still strong, all of those words and his information and his thought process behind it, whether it's his real opinion or he's just spitting facts, okay, comes from lagging data. Okay, so tomorrow we're going to get the second quarter advanced GDP number, which right now the Atlanta, Fed, which is a model estimate, shows a 1.2% decline. Now that technically would be two consecutive quarters, which originally would be a recession as of previous definition. However, I'll cover that and I'll give you really a neutral bias when talking about this. So this article states, no, the White House isn't changing the definition of a recession. So just a couple comments about this and why I feel that even if we did, get that, negative number, I don't think investors are going to react in a very strong manner. Couple reasons why. One, it's completely known that there's a high probability of that happening. Okay. Two, this, I understand where they're coming saying that they wouldn't officially, the media very much wouldn't officially designate this as a recession, okay, or the Bureau of Economic Research, because generally in a recessionary time, you have much higher unemployment than we have now, okay, much less job openings and less job growths. Here's where things change a little bit, okay. Obviously, the economic expansion last year was much higher, okay, not only because of the demand, the massive amount of stimulus that was put out, but also the fact of the supply chain was really just catching up from 2020. All right, so I do understand that aspect of it. As far as unemployment, well, look at how many jobs out there are hiring and can't find people. Okay, so a lot of people from what that data tells me is that the individuals that were on unemployment just are not working now. Okay, they're not getting that extra money like they were. All right, the extra $600 or even $300 a week like they were as of in 2020 and as of even part of last year. Okay, and therefore they haven't gone back to work. Whether they started freelancing, started their own business, whatever they might have done, that's why you see a little bit of a difference. Now, on the contrary, okay, I don't feel like the White House was the proper party to put out this information. I feel that naturally it's instinct for people just to say this is for their political agenda, which it very well could be. All right, it should be something that the Federal Reserve, okay, or Jerome Powell should have stated, given the fact that the Federal Reserve is supposed to be a, non-binary neutral, okay, party and not a part of the government. But when it comes to how the market might react by that news, it's not really going to be news because it should be priced in. But here's the thing, and this is what people are focusing on the most, okay, when you, even if you go right and you read some of these articles, is the fact that it's talking about unemployment, it's talking about job growth. Well, if you remember on a previous video that I made, we talked about these mega companies. There's Google, Microsoft, Facebook, okay, Tesla. Elon Musk even said he expects economic, decline and less spending, less buying. He's going to lay off 10%, of his workers at Tesla. You've watched these big companies already start the ball, okay, of rolling, of talking about layoffs, slowing of the hiring. So by the time that unemployment number starts to rise, it's going to take a little bit of time before that happens. All right, so we've already seen that ball happening. Another thing I want to talk about too, which I've also mentioned before, is how the housing market, because housing market makes up so much of GDP. Check out this chart. This is the monthly supply of new houses in the United States. Now, there's a couple things to this. There's just a lot of houses that were, finished being built at the same time. Okay, but you're also seeing the fact that people buying houses is starting to slow a little bit, especially with mortgage rates rising. Now, mortgage rates rising, it takes a little while, okay, for the housing prices to come down and actually for the sales of houses to come down. The reason being is because when you go to purchase a home, the first thing a realtor should ask you, are you pre-approved? And if you're not pre-approved, well, then you should go get pre-approved. And many times you get what's called rate locked, which generally speaking, you can get rate locked for 6 months, meaning that some people that are still buying houses, they might have a 3.5% or 3.75% interest rate, and they're not really at that, 5.7% or potentially 6% what it's going to be in a month. And that it takes a little bit of time for that housing market to react to the interest rates moving. It doesn't happen that quickly. But looking at this chart going all the way back, and you've seen how this chart starts to spike up, these shaded areas, you already know what they are, times of recession. You look at 2008, same thing, spike, 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 spike going into it, boom, same thing. So the pattern tends to repeat. All right, and I look at the housing market very closely because it makes up a huge number of GDP. So combine that housing data with the fact of these big companies talking about layoffs, just know that that information that they're giving us is lagging, and the fact that the market is very forward thinking, okay, but they have to try, the market has to balance things. All right, so it is going to take time for the market to react as well. Now, unfortunately, when we zoom out, and I will say this to everybody, when we zoom out, okay, and I'll just look at this area on the weekly chart, and it seemed like everybody right here was bullish at 480. And even when we hit, everybody was still bullish at 460. And it was only a time to where we got down to like sub 400, okay, that 380, that 360, where it just seems like the sentiment was, oh, we're going to the ditches, we're going to 300, it's going to keep going down, down, down. Well, we know that, I've talked about this, when one side gets crowded too much, a lot of times the opposite can happen. And just keep that, going into. Now, if you hear things about a certain trade, if it's, a sure thing to happen, do your own research. If the chart matches up to it, okay, if the macros match up to it, all right, if you think the earnings or whatever you're playing it matches up to it, then yeah, have conviction on it and go forward. But if it's something that people are just talking about and some things don't fully line up, you're going to see the opposite happen, really, just because that's what market makers do. That is part of the market manipulation. That's exactly what they do. So guys, keep that in mind. That's it for this video. See you in the next one.